It's one thing to win a trade, it's another to be consistently profitable. Each time on the winning trade, we take a look at successful option strategies that take advantage of the current market conditions through the passage of time. For those serious about becoming successful, consistently profitable options traders, now is the time to build skills in technical analysis, market analysis, and applied volatility to get those results. We have multiple memberships, starting with our Go membership that teaches rules-based trading and our Pro membership that teaches more subjective trading. For more information, go to lockeinyoursuccess.com/memberships.
Hello everyone, my name is John Locke and I'd like to welcome you to The Winning Trade, but first the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial and please make sure you are aware of all your risks prior to placing any trades. Also note that in this presentation, we are covering hypothetical computer-simulated trades and results. They're believed to be as accurately represented as possible, but keep in mind live results can vary from simulated results for many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance, wealth, and success coach with Locke in Your Success, LLC, where myself and my team of mentors are here to help you win in the markets and in life as well. And today, I have a special twist on our high probability options trading, and that is to talk to you about the power of adding a small amount of technical bias to trade structures that are already very high probability. So today, what we're going to do is we're going to cover a trading strategy called the M3.4U. The M3.4U is the core non-subjective trading strategy that we use for stage 3 in our trader success blueprint, which is for those traders who are still in the non-subjective trading realm. But the M3.4U is much more than that. It's also an extremely flexible strategy that we can modify slightly and bring in our technical biases, and we bring in our implied volatility biases, and we can make minor modifications. Not modifications enough where we're going directional, but enough modifications where we can make that strategy cover a much larger range. We can do it with much less risk of drawdown, and we can do it in a way where we're much more likely to win, even a higher probability than the strategy itself has when it's traded non-subjectively. So the M3.4U by guidelines is a somewhat bullish bias market neutral income strategy for the Russell. It's extremely effective. It requires a minimum of $2,500 per trade. We're going to do a example size of $15,000 planned capital. The profit target that we're going to have is none. There is a benefit to not having a profit target at times, and there's a benefit to having a profit target at times. Realistically, a fixed profit target takes away all your big wins, but no profit target lowers your win rate, because sometimes what happens is you get up quite a bit of money and sometimes you end up losing the trade or losing some of those unrealized gains. Both methods have their advantages and disadvantages. The question becomes, when do we get out at a certain amount of money that we're up maybe in the position, and when do we hold that position to gain the maximum value out of it? That is what stage 4 and stage 5 in our Trader Success Blueprint is all about. So with this trade here, we don't have a profit target, but we expect a good month to return about 50% of our planned capital. So in this trade, we have a planned capital of $15,000. If things go well, we're expecting $7,500. If things go poorly, we do have an exit loss trigger of $1,500. But realistically, most of the time when we trade in this manner, we're not going to get anywhere near that number. So let's take a look at this particular trade. One of the things you'll notice if you know the standard M3.4, guidelines tell us to enter 56 days to expiration. We're entering at 42. And when we trade this way, we're entering based on whether the conditions are right or not. We don't really care necessarily what the date is, but rather we're looking for good entry conditions. And that is the distinct difference between our guidelines non-subjective traders and our subjective ones. So if I'm entering at a random date, I might have good entry conditions, I might not. If I'm waiting for good entry conditions, then when they come, I have the opportunity to take advantage of that. So what's going on here that makes this a good entry condition? What happened is we're going along here, and then in the Russell, there was just a very large drop in the Russell. Now, this scares most income traders because they say, oh my goodness, I'm going to wait till the market settles out. But the reality is this is when you want to get in. This is the most advantageous. You have an implied volatility advantage, and then if we've gone down a lot, we also have a support and resistance levels and so forth in the marketplace, which also give us a price directional advantage where the price is not likely to do something. So in this case here, we're going along, we had some big down days, and now I'm like, oh, wait a minute. Today we have 3 strong down days in the asset. We're going to have a really nice implied volatility advantage because the implied volatility is nice and high. Our T+0 line is going to be depressed a little bit. Also, if I am in a position where I believe I have technical advantage, in other words, the market's not likely to go down a whole lot, I can also take on a little bit of delta risk. So that's the case here, right? So standard position this size, I'm looking at a maximum positive delta of positive 20. I'm looking at a maximum negative delta of 15 in my position. Now, I'm not exceeding those levels on entry, but I am biasing them a little bit towards the positive delta side because, I don't know where the market's going to go. It's probably still going to come down some, but it's already come down most of the way. So what I want to do is I want to lean this a little bit positive delta, particularly if I'm entering on a down day. So this is our position here. And again, if I have a $1,500 stop out, I can basically take this down all the way to 1675 or so without even looking at it. I'm not expecting an implied volatility problem because the implied volatility is already high because the market's really coming down. It's just a lot of advantages to this entry over just randomly entering the marketplace. So I'm just going to go with this day by day, and we'll see how we do. Before I do, though, please remember to subscribe and share our videos. Again, it helps us bring you this great content. So let's move forward day to day. The market continues to drop down, and we do take a little bit of a P&L hit, but nothing bad. So if we look at our price chart, you can see we actually had a gap down, and we came all the way down into the 1720. And our drawdown here is minimal. Our drawdown is minimal because, again, we had such a good entry. So let's move forward here. Now we're just kind of bouncing back and forth. You can see that even though we're down lower and the market continues down, we're gaining money. And again, that comes to the implied volatility advantage. The implied volatility is coming out of the marketplace, and we're trading essentially implied volatility in these types of positions. We're doing okay. So let's just kind of watch this go back and forth. Again, the market is still kind of going down. So we definitely do not have to be right. Here we're reversing. Take a look at this. We are up $1,000 in only a few days. And the market actually is kind of going against us in the position a little bit. But because we got a good entry, we don't get those drawdowns. Let's move forward here. March 22nd, this is only 12 days. We are up $2,400, which, by the way, is the profit target for many strategies, or actually exceeded the profit target. So if we had a $15,000 planned capital, then our profit target would have been $1,500. We'd be out of the trade. But here, we're up $2,400. We would have given up $1,000. Also, while I'm here, I'm going to note that standard M3.4U positioning this size has a $25,000 planned capital, but we can trade this with $15,000 planned capital because the reality is we can control our capital in the position, and it gives us higher returns with less capital. So moving forward here, and as this is going along, I'm very aware of what the market's doing here. I'm very aware of where my support levels are in the market, and I'm very aware of information that leads me to believe that there's going to be a problem with the position and I'm going to have to do something, whether that be exit or whether that be reconfigure the trade. As of this point, we're still longer term bullish, even though the market's going down, even though the market's going against us. We're also positive 23 delta, which is slightly over our maximum delta for a standard M3.4U. But one of the things we can do here when we're being subjective is if we still have a bullish bias in the marketplace, we can allow a bit of flexibility in the guidelines. We can let this go maybe a little bit extra because our primary belief is we're still bullish in the marketplace. And there's going to be a point at which we're wrong, but even if we had hit that point, our loss is going to be minimal, maybe even slightly positive. So moving forward here, now we're up $1,800. Now we're up $2,000. Now 2760. And here, finally on this day, the market starts to push the upside or confirms our bullishness. Remember, we entered this in a range where we thought the market was probably going to go up. We were wrong. The market went down more. But that's one of the wonderful things about these strategies. You don't have to be completely right. You can be off quite a bit and you can still do extremely well. And that's the case here. So you can see that we're kind of consolidating in the sideways range, but we're back up to the top of our range again. And if you look at the market, what the market's been doing in longer term time frames is basically it's been coming up to this level of 2000-ish, and then it's been somewhere between actually around 1920 or so, and then it's been cycling back down to this level in around 1700, and then it's been cycling back up. So our longer term thoughts here is that we're still going to go up in the marketplace. It's just taking longer than we thought. And that's another thing too, as new information comes into the marketplace, we may change our opinion a little bit. But here it starts to make sense to maybe flatten this out. So what we're going to do is we're going to make a regular adjustment. And realistically, this is within standard M3.4U guidelines. So it's not like we're way out of the reservation. We had a positive 20 and a minus 15 limit. We pushed the positive 20 by a few delta because we were bullish bias. Now we're hitting our maximum delta limit from a standard guidelines trade. And we're going to take that seriously because, again, we have a bullish bias. So I'm going to go ahead, I'm going to make that trade by the guidelines. And I'm going to open this up. And basically, I'm taking 5 1800s to 1790, and that's flattening us out, again, within our standard trade guidelines. Now from here, we pull back a little bit, then we push forward again. So we can see on the charting that we had our resistance point. We exceeded our resistance point here. And again, being a little bit bullish bias, this adjustment is within our guidelines as well. Because we have a minus 15 delta for an adjustment, and we're at minus 17. So what I did is I sold 5 1790 1780s, and this is where our position sits. So if I go another day, we're now outside the long strike, and standard M3.4U guidelines say if you're outside the long strike, then your delta should be 0 or positive. We're negative delta. This again is pretty much a standard M3.4U guidelines. Notice that we actually, with our last adjustments, we did let the capital get over our planned capital number. That's a subjective decision on whether you want to do that or not. We do allow ourselves to do that in certain conditions. We don't like to stay there very long. So with this up adjustment, what we're doing is we're bringing in some of our long strikes and on the bottom and some of our long strikes on the top so that we don't gain any more capital in this position. In doing so, we're bringing ourselves near maximum positive delta. We end up being wrong. Does this happen sometimes? Yeah, it happens a lot. Our thought was that we were going to break out of this and we were coming to up into this level. This is new information in the marketplace. Basically, we had a really big down day, and it actually broke a support level here. So that being the case, we do want to take that seriously. And we're also outside guidelines with our positive delta. We're over positive 20. So I'm going to go ahead in here, and I'm going to take 5 of these. I'm going to bring those back up to 1790. And now this gets us back into our standard plan, within our standard plan capital number. And it also brings us still positive delta, but within our delta range for standard and 3.4U. So I'm going to go to here. We continue to get a down move. It throws us outside of our delta range again. And I'm going to do a move that's a little bit different than standard guidelines. One of the things that we can do is rather than fix our delta from here, we can actually fix it from here. And the advantage to fixing it from here is, number one, it takes capital out of the trade. Number two, that lower capital level has a reduced risk number. So it corrects our delta, it takes capital out of the trade, and if the market just falls apart, which is basically what I'm concerned about now. Okay, we had a breakout that failed, and now we're coming back down here. And now I'm a little bit concerned that maybe the market's going to try and retest this bottom at this point, because most of the time, technically, that's what happens. So rather than keeping myself really exposed to risk down here, I'm going to start cutting that back. And you'll see how this move here cuts our capital in our trade down to about $11,000. It corrects our delta, puts it back in the range, and now we're still in the market, but we're in with a bit of a smaller position. So here, I'm going to go next day. We look like this. On this Monday here, we end up going back up again. I'm outside my standard M3.4U guidelines. Price chart is it's not telling me anything at this point. Basically, we're in chop, so I'm just going to accommodate for that. I'm going to roll down 5 of these, and that's going to bring us to flat delta. Okay, so one of the things about applying subjectivity is there are times when we believe we should be positive delta, like here, 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 and here. There are times when our signals fail us, which is here. I go back to neutral standard M3.4U guidelines, more or less. And now we're kind of in chop, and we're not sure where the market's going, so we're just kind of staying in M3.4U guidelines. We know those guidelines are high probability. We know we're probably going to do okay if we follow them. And I don't have a strong technical bias at this point. So we're just pretty much standard guidelines. At the same time, because we have increased risk, because we're coming into expiration, because the market movement is a little unpredictable at this point, we're just following standard M3.4U guidelines at a smaller size. Okay. If we go here the following day, the market continues to go up. And what I'm going to do is I'm going to bring in some of these contracts. I'm also going to bring in some of these contracts to keep my size sort of under control. I'm allowing myself slightly overplanned capital again here. Again, I could fix that if I wanted to. I just roll this in a little bit more, roll this in a little bit more to make the size smaller. But this to me is acceptable. Again, we're starting to bounce. Things are coming up. But now I've had a reaction off the market here at this level of 1800. And one of the things we do is cross-index analysis, so I'm also looking at the SPX. And at the same time, one of the things that's happening in the SPX is it's coming into a major resistance level. And if the SPX comes into a major resistance level and the Russell's coming into some sort of a resistance level, which is a previous swing high, chances are we can add some upside risk, because chances are the market's not going to go too much higher. I'm not doing that yet, but I am starting to consider this. So here, if I go to the next day, end up getting a down move. I'm over my M3.4U guidelines again, and we're still a little uncertain about the downside. I'm starting to become less concerned about the upside and more concerned about the downside. I'm going to make an adjustment here, and again, my adjustment is going to lean towards reducing size, given my proximity to expiration and my uncertainty when where the market's going. So I'm going to roll these 5 higher. That's going to bring me back down to like 11,000 planned capital. It's going to make a delta correction, put me inside my normal guidelines here. Following day, we end up getting a decent size up move. I'm able to identify that I'm kind of in choppy environment here, and that chances are, again, given the location of the SPX, that we're probably going to hold, not go much higher than 1800 here. So what I'm going to do is I'm going to put a bearish vertical on here. And I'm going to carefully place that bearish vertical in an area where I'm really pretty certain the market's not going to have a problem. So what I did is I added a bearish vertical here. And then to make a delta correction so that it's not so painful if I'm wrong, I'm also making my broken wing butterfly smaller and more positive delta. So I'm taking, you can see that we also took 5 of these at the 1780s. We brought them to 1760, and we're bringing some of these up here to 1720. And that gives us an analytical graph that looks like this, where I could make another $1,500, and so long as I don't get threatened to the upside, that's fine, or to the downside, we stay in the position. If we get threatened or it does something unexpected, we can just exit the position, really at a very good profit. So this is where we stand. I wouldn't do this bearish vertical all the time in this position. I would only do it if I have some sort of a technical reason to do it. And I also have a stop out point for that technical reason. So this is what we look like here. Again, my technical reason is this swing high probably isn't going to be exceeded. And if it is, by the way, that's information and I can change my positioning. But here, I'm going to go to the following day. We get a 20-point down move. We're a little bit over delta, but I'm not too concerned about it. Following day here, we got plus 21. I end up being a minus 42 delta. You can see we're at pretty much maximum profit unless we drift back a little bit. So I'm going to make an adjustment here, and I'm going to do basically the same thing. I'm going to make this butterfly smaller. And you can see I rolled the 5 down here. I rolled the 10 up higher. And it puts me in this position. My total risk in my position, if the world came to an end and something crazy happened, we are would be a minus $2,500, which isn't bad. And we're up 68.20. We can see if we can ride out the next 4 days and not have a problem here. So the next day here, we get a bit of a pullback. We're up 73.70, and then the following day here, we are up 74.45, and from there I'm just going to expire the position. So if I'm going to go to the next day here, you can see we're in this position here. It says we're up 76.45. It's not going to execute for that. It's going to execute for whatever this basically T plus 0 line is, or this expiration line is. And then from here, given where I'm positioned in this, I would just expire it. You never know. We might have a bad day in the morning, and we may end up giving up $17,000 if the settlement gets there. We could lose money too, but that would be extremely rare. That would take a settlement gap over 50 points, which is pretty unusual to the downside. And the same thing to the upside. We have an awful lot of room here, about 70 or 80 points for settlement overnight, which again, that would be extremely, extremely rare, especially given the market conditions. So we're just going to let this expire, and we are going to be out for a profit of about $7,600, or nearly 50% in only 42 days, for this episode's winning trade, the Stage 5 M3.4U strategy. If you like what you see, please subscribe to our YouTube channel and make sure you share our videos. It helps us spread the word about these wonderful, powerful strategies. Also, if you'd like to learn more, come on over to lockingyoursuccess.com or thewinningtrade.com. And in those locations, you can discover how you too can follow along with this type of trade and many other great strategies as they unfold during our weekly trade update webinars. Also, at thewinningtrade.com, you can learn about upcoming winning trade presentation, explore past winning trades, and receive access to free bonus material. And perhaps most of all, you can check out our free trading performance podcast to help you skyrocket your trading results regardless of the type of trading you do. If you have any questions, comments, or anything else you'd like to see, please make sure you post that in the comments, and I'll make sure I answer your questions for you personally. Thank you for joining me. I look forward to seeing you on the next Winning Trade.